Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today. All right, so today's chart is the ratio of emerging markets versus developed markets. The way we're looking at this is a simple ratio of two ETFs, the EEM, which is an emerging markets ETF, and the EFA, which is an EFA ETF, which is basically global developed, developed markets in Europe and Asia. So basically developed Europe and Japan, essentially. Now, this ratio is part of my Mindful Investor Live chart list that I have on stockcharts.com, which is basically walks through the steps that I follow in my macro analytical approach. So it starts with price, it goes to breadth, and then it goes to sentiment. That's sort of the priority order. So price first, what is the price of the overall equity markets doing? What are the markets doing in terms of price? Second is breadth. What can we talk, what about the components of those indexes and what are they doing? What can that tell me about the overall price? And then finally, sentiment. What are people saying or thinking about their investments? And that's sort of the priority order. But after that, I think as an investor, you're left to try to differentiate different parts of the equity market. Let's say we want to, we think equities are a good component here. We think there's upside there. Well, what do we actually buy or sell at a given moment? I think that's where ratio analysis can be really helpful because it's really designed to help you differentiate between different parts of the equity market and also other asset classes as well. So part of my Mindful Investor Live chart list goes through a series of these ratios and helps me, look for what's working and what isn't. And by comparing different assets together using ratios, you can identify where there might be opportunity. So the chart that caught my eye is this one, which is the ratio of EM versus EFA. And if you look, again, if this chart, if the plot is going higher, that means emerging markets are outperforming. If they move in, to the side, move sideways, that means they're moving relatively in lockstep, relatively together. If the line's going down, emerging markets are underperforming developed markets. You can see that the ratio really shot up after, sort of mid-late June and went to a new swing high there. From there, sideways through much of the summer, and then going into October, the last 4 weeks have been remarkably strong, sort of continuing this uptrend. Now, there are a lot of reasons why this could be happening. China overall is done very, very well. The MCHI is at new 52-week highs. This is as the S&P and a lot of global global markets in Europe not testing new highs, and that's why the ratio is certainly going higher. Strength in commodities would most likely move this ratio higher because that's a lot of commodity oriented markets are in EM. But the fact that this is going higher tells me this: if you're thinking about your non-US equity allocations, you have X% in the US and then Y% non-US. If you think about where that portion might be allocated, what this chart tells me is I want to make sure that I have enough focus on EM because that's really what's working. If you just look at the international piece, you're doing much better if you own EM versus developed for global stocks. So that's why this chart caught my eye. Now, my actual one chart for today is this one, which is the ratio of EM versus EFA. I have the 200-day exponential moving average here in green. And then I'm looking at where the price is relative to its 200-day exponential moving average here at the bottom panel. So this is actually showing you where we're at relative to the long-term trend, right? So it's how far is the price from, or the ratio from, this moving average here in green. So you can see when this histogram is very high, that means we're pretty far away from the average in form of the 200-day exponential average. If it's very low, that means we're pretty far below that exponential average, that long-term smoothing mechanism. So what's interesting is you can see that this ratio is breaking to new highs. It's actually going above its peak from 2018, also going above its peak from 2014. So this ratio has really been basing for quite a while. And this breakout that we're seeing right now is actually taking us to a new high for the last 5 years, really, if not more. What's interesting, though, so from a mean reversion standpoint, what concerns me about this ratio spiking so quickly and getting so far away from its moving average is that it tends to be unsustainable. We're about 7.7% above the 200-day exponential moving average. The last time we were this high was back in early July, which was the end of that run before we sort of chopped around for a while. And we really haven't been this high at all for the last, 9 years before that. So overall, we've really gone very, very high. So
if you look at that ratio and you think about mean reversion, we've gone really far away from that smoothed out price action in terms of the 200-day exponential average, which in general would suggest to me we've gone too high too quickly. You'd expect a bit of a reversion back to that mean. Now, that doesn't mean, if you look back here in mid 2016, we went pretty far away from the exponential average. We came off a bit, but overall the trend remained positive. So this is more of a short-term mean reversion sort of play, but overall the trend could certainly be continue higher. And the way we're going to demonstrate that is by bumping out another 8 years. So now we're going back to 2003. And here's the kicker. If you look in a sort of a secular bull phase for this ratio during extended periods where emerging markets have been outperforming EFA, that actually can go above 7-8%. It can go even as high as 15+%. And overall, that is still within a longer term uptrend. So just because we've gone up a lot does not mean we can't continue, this ratio can't continue to go up a lot further for a longer period of time. Now, you're going to notice within this long-term uptrend, there were certainly weaker periods, and that's when the ratio becomes really extended, 12, 13, 15 plus percent away from its exponential average. That's when you can see it really tends to mean revert in a much more significant way. And again, even given the longer term uptrend. So the way that I would think of this, again, looking back at this chart, number one, you have to recognize that EM has been outperforming. So overall, I think over a longer period of time, I could see a scenario where emerging markets continue to outperform. So I think you want to really pay attention to how you're allocated outside the US. Number two, we've gone so high so quickly. I don't know if now is necessarily the time to be thinking about that continuing. I could see a scenario where we would mean revert and come back to this average. So I think there could be a time where it might be a better opportunity to lean into this ratio if you're not there yet. Finally, I would say based on the long-term chart, you can see that just because we're that far away doesn't mean we can't remain that far away over a longer period of time. And so I think short-term pullback within a long-term uptrend sort of lines up with what we've seen with the historical trend on this ratio. And again, my main takeaway for this one chart is to remind you that if you're looking outside the US, number one, always be thinking about your international allocation. And this just tells me the fact that the ratio has done so well and is breaking to new highs for the last 7 or 8 years tells me to make sure that I have a proper allocation or a proper attention to emerging markets and not just to international stocks and thinking that satisfies it. That's a little look at the emerging versus developed ratio. Hope everyone is well and wish you the best here from the Market Misbehavior team. Thanks a lot.